5 seconds to the open. You ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to you all around the world. Welcome to another episode of the Follow the Money podcast. I'm your host, Jerry Robinson, your guide on this journey to financial freedom. And I'm thrilled to have you here with me today. We've got a jam-packed episode for you, so I want to dive right in. Today, we're going to be talking about something that's been grabbing a lot of people's attention on Wall Street and just among investors and traders, and that is the soaring price of gold and silver. We saw gold recently reached record highs. It's been hitting record highs quite a few times this year. Silver has recently touched a 12-year high. It was sitting at around $35 an ounce. In fact, earlier this week, it's pulled back a bit from that level as I record today's broadcast. I'm also going to break down why we're seeing the surge in gold and silver. And we're also going to talk about what it may mean for your portfolio moving forward. You know, if you're an investor in precious metals, or if you've been thinking about it, you won't want to miss today's episode. Then in segment 2, we're going to provide a broad market update. I'm going to talk about the latest action in the S&P 500, the Nasdaq 100, the US dollar. We'll talk about Bitcoin and Ethereum as well. We'll talk about what's been happening in these markets and how they're reacting to economic and geopolitical developments. And as always, I'll wrap things up with my final thoughts, leave you with a powerful final word to inspire you for the week ahead. So stick around for that. All right, folks, it's time to get started. So let's dive right into today's episode. Grab a cup of coffee, sit back, and enjoy the ride. All right, friends, let's dive into our first topic today. We're talking about the big surge we've seen in gold and silver prices so far in 2024. Of course, the year's almost over. We've had 10 months here of just seeing the price of gold and silver really begin to accelerate it, particularly gold. We've seen silver pick up recently. It's been quite a year for these two precious metals, and I know many of you have been watching these moves closely. Many of our followers and members and students and listeners, many of you understand the importance of precious metals in the overall global economy. That many of you, I'm sure, have been watching this closely. You know, gold has been hitting fresh record highs and silver sitting at around 12-year highs, recently touching that $35 per ounce mark. Now, to put this in perspective, this surge is not coming out of nowhere. Back in January, we released our 2024 market outlook for all of our followthemoney.com members. We forecasted that gold and silver would outperform the S&P 500 this year. We had many reasons for laying out that forecast. We saw many reasons why we would very likely see a rise in these two assets. And if you've been following our analysis, you'll remember also that we discussed this back in March on episode number 458 of this podcast. The episode was entitled Gold Hits New Heights. Well, here we are. 2024 is proving to be a pivotal year for these two metals. So let's just provide an update here and explain why gold is surging. Here we are in the final months of 2024. What's going on? Well, there are several reasons why gold is continuing to push higher. First, we can talk about the inflation fears that many people have felt since inflation really peaked out back in 2022. And as we've also seen the US dollar coming down from its peak back in 2022, as the dollar comes down in value, it causes investors to, flock to gold as a reliable store of value. And so we've certainly seen that. Although the dollar has shown some near-term strength as of late, it hasn't slowed down gold. Gold has just pushed higher, and silver as well. But that's not the only driver. We're also seeing, unprecedented global uncertainty, right? There's a lot of fear around the world right now. Geopolitical tensions rising, especially in the Middle East, where we are praying for those who are involved in so much bloodshed, and Ukraine as well, the wars that are going on around the world. We also have the upcoming 2024 U.S. election that's just 2 weeks away. That, of course, has created a lot of uncertainty that we expect will be resolved once the election results are in. Markets hate uncertainty, and gold thrives in times like these. Additionally, you have central banks around the world that continue to stockpile gold. This year has seen strong purchases of gold by central banks as they look to hedge against the global instability, and also continue their de-dollarization as they diversify away from the U.S. dollar. So when you see central banks, buying gold in droves like we have over the last several years, it's a strong signal that gold's safe haven appeal remains intact. No matter what they say in the financial press, gold has simply never been higher in terms of U.S. dollars as it is today. There's also some other critical factors here. We have global monetary and fiscal easing campaigns going on all around the world, right? So we've entered now a new rate cutting cycle. The Federal Reserve has already cut interest rates for the first time since 2020. That happened just a little bit ago. We expect another rate cut from the Fed next month at its meeting in November, and then again in December. That's what the futures market is indicating. That's what the Fed has also kind of forecast or telegraphed to us. So we have the rate cutting cycle beginning by the Federal Reserve, and then you have the European Central Bank, the ECB. They've already cut rates 3 times this year alone, and that's also helping stoke potentially some growth across the European Union. Then we also have over in China, Beijing is promising to juice its sagging economy with fresh stimulus measures. Beijing has really, as of the last few weeks, if you've been watching their stock market, you've seen their stock market pop. And the reason, of course, is because they have been promising to unleash a bazooka of stimulus over the coming months. And we've already begun to see that. In fact, earlier this week, Beijing cut mortgage rates by a larger amount than expected, and that also kind of juiced the economy. So Beijing appears to be also moving in a place where they're willing to take on debt to prop up their economy. So you have the United States, you have Europe, you have China, all of them now engaging in a rate cutting cycle, right? And that kind of monetary and also fiscal easing, which we're also seeing from Beijing, is helping basically stoke asset prices. And when you have all of these easing measures combined, they're just helping push gold prices even higher. And gold is simply a major beneficiary of these monetary policies that we're seeing around the world. Now, it's not just gold, as I had mentioned to you. We have also got silver. Let's talk about silver. Silver tends to follow gold's lead. If you go back and you look at the historical charts, you can just kind of see how gold and silver interact during their rallies. You'll often see gold tend to lead the rally until toward the final innings, and then you'll see silver overtake gold and then often go on to a spectacular run before it finally fizzles out. So silver has been surging for its own reasons. Silver is both a monetary metal and an industrial metal, which means that it benefits from increased industrial demand, especially in clean energy technologies like solar panels and electric vehicles. Silver is just incredibly critical to these industries. And as the world continues to transition to clean energy, demand for silver is just expected to continue rising. So you have supply, demand fundamentals that are helping silver rise here. Silver has been in a deficit now for some time. We expect that to probably continue. And as we look at these types of assets like gold and silver, we also see that, particularly silver, it gets a boost because it's not just a monetary metal, it's also has an industrial application. Well, as China and others begin to cut rates and stoke economic growth, well, that means potentially more demand for the industrial uses of silver. And so that is also putting, a bid underneath silver, pushing it up. But silver also appeals to investors as a more affordable alternative to gold. Many are seeing gold rise, and they're looking at the price tag of gold, nearly, somewhere $2,700-$2,800 as I record this. And, many people look at that and say, gosh, I guess I'll just buy silver instead. Silver's, at nearly $35 just a couple of days ago. That offers a way to gain exposure to the precious metals market without as big of an upfront cost. Now, what's interesting, as I've said, is that, silver tends to be more volatile than gold, which means that we could see some pretty hefty moves ahead as silver plays catch up with gold. And that's what we're, kind of watching for and expecting. So now, what does this mean for investors? You're out there listening to this, you say, what does this mean for me? Well, whether you're a long-term investor holding gold and silver as a store of value, or whether you're a short-term trader who's just looking to capitalize on these recent price movements, 2024 is just simply shaping up to be one of the best years we've seen in quite some time for precious metals. But just like we've seen with gold's strong rally from its lows in 2022, you got to remember that these kinds of rallies can experience pullbacks. So gold has now pushed into historically and technically overbought territory on the when you look at the technicals on the charts. That doesn't necessarily mean that the rally is over by any stretch of the imagination, but it does suggest that we do expect that we are in the final innings before we move into a period of consolidation in gold. Now, we may just go sideways for a while and then move even higher. As I've been saying now for some time, we do expect gold to pierce above $3,000 and even higher as we move forward because we're just in an inflationary kind of economy. When you have a debt-based economy like we have here in the United States, you have to expect that. And so as they continue to debauch the currency with no end in sight, there is no one addressing the national debt here in the United States. Neither political party has an interest in talking about it. We've heard nothing about the national debt at any of the presidential debates here in the United States. Neither the Republican candidate nor the Democratic candidate are talking about the national debt. What does that mean? That means that they plan on spending and spending and spending, and they have no plans to reduce that national debt. What does that mean? Well, that means that things like gold are going to continue to, be able to rally with the concerns over the extreme amounts of debt that the United States continues to take on. And we're not alone, right? Many other countries are doing the same thing. So here's a key takeaway, though, when you think about what's been going on. Everyone who has ever bought gold up until this point, I'm talking about bullion now, not the numismatic Elvis coins or whatever that have an extreme value or whatever, but the actual bullion itself. Anyone who's ever bought gold, you're in the black right now. It's really something. That's a testament to the value of just simply holding gold over the long term. Now, right now, as I mentioned, gold's sitting at record highs. And it may be, and I want to stress the word may, it may be a good time to take a little cream off the top here. Locking in profits can be wise, especially in times of uncertainty. We have the election just straight ahead. We could see, a sharp move in either direction in the wake of that election. And here's the thing, you've often heard me say, it's important to have an allocation to precious metals in your overall portfolio. For me personally, I keep a relatively small, but nonetheless an allocation towards precious metals in my overall long-term investment portfolio. However, if you've been stacking gold and silver for some time, particularly gold, not necessarily silver, but gold, you've just simply never had prices where they are today. And so, taking, 5 to 10% of what you have, of your overall portfolio and locking in some gains here, and maybe even using that cash to buy more gold, maybe on a pullback, or to look for another place to allocate it towards that may, be under bought right now, that may not be so technically overbought like gold, may be a good idea. I certainly don't think that everyone should jump right into gold here at the very peak, and we don't know that it's the peak. But right now, if you look at a chart, we've never been higher, right? And so there are times of uncertainty lingering ahead. We've even seen some investors reallocating profits from gold into silver. Some of our students have been doing that. Some have so like well, I'll give you a perfect example. One of our students recently sold about 5%. According to what he had told me, he sold about 5% of his overall gold holdings, with prices being where they are, and also with the technicals being where they are. And he just took that 5% and he's putting it into Bitcoin, which he thinks is going to have a really great year as we move into 2025. And I think, that makes a whole lot of sense. I think it could be a very wise move for that person. I have another student that I'm thinking of who has recently taken a little bit of cream off the top on his gold holdings, sold a few ounces, and he's putting that into silver because he expects that silver is going to really ramp up over the next few months. So obviously that's up to the individual. But what I'm saying is that it does behoove you to think in terms of what do I expect from these metals going forward. And also, if you've been stacking for, 5, 10, 15 years, however, and all of your position is completely in the black, taking a little cream off the top and patting yourself on the back, there's nothing wrong with that. Definitely, I wouldn't be considering of selling out my entire position, but taking a little cream off the top never hurt anybody. In fact, you don't make a profit until you sell. So I would just be keeping that, in mind. Now, silver, by the way, is still below its all-time high of $50 per ounce back from 2011. And with industrial demand rising and monetary easing and fiscal easing across the globe, kind of increasing, silver has plenty of room to run, in my opinion, based upon those historical and technical, the same historical and technical reasons. Gold, as I mentioned, is really quite overstretched on the technical side. But when you look at silver, you say that's not the same. It has plenty of room to run, in our opinion. So we think silver could continue pushing higher as global governments fuel their economies with stimulus and easy monetary policy, trying to prevent any kind of slowdown economically or to stem any kind of slowdown. So to sum up, 2024 is proving to be a pivotal year for precious metals. As we had told you at the beginning of the year in our 2024 market outlook, we fully expected gold and silver to do well this year, and we're likely to see even more gains as geopolitical tensions and global monetary easing continue to drive uncertainty and push gold and silver prices higher into 2025. That's our expectation. So there's a little bit of insight for you on what we're seeing from the precious metals market. You know that for a long time, Tom Cloud has been the precious metals advisor that has been a sponsor of followthemoney.com. He recently put out a brand new video talking about some of the updates. You can find that in today's show notes. We'll have a link to that. And you can also contact him if you have questions. If you're wanting to buy gold, you're wanting to sell gold, he's a dealer. You can always contact him. Just give him a call if you want, 800-247-2812. Just tell him that Jerry from Follow the Money sent you. He'll give you the very best deal on whether you're selling or whether you're buying. And he'll also throw in free shipping on every order. If you do happen to buy, you won't have to pay any shipping at all. You'll get free insurance. But just be sure to tell him that you know Jerry Robinson from Follow the Money. That's how that red carpet gets rolled out. All right, well, let's take a quick break. And when we come back, we'll dive into a broad market update, including stocks, the dollar, and cryptocurrencies. Stay tuned. Hey friends, Jerry Robinson here, followthemoney.com. Now before we jump into our next segment, I've got something exciting to share with you. If you've ever thought about improving your day trading skills, or maybe you've been curious about how to navigate those fast-moving markets, I want to invite you to join our brand new 30-minute Breakout Blueprint day trading course. This is the very strategy that I've spent many years perfecting. And whether you're already a day trader or just looking to sharpen your skills, this course could be exactly what you need to up your game. And here's the best part. For a limited time, you can save 15% on your membership here at Follow the Money and get access to this course and all of our other courses by going to followthemoney.com and simply using coupon code JUMPIN15 at checkout. That's JUMP as in JUMP IN15. Jump in 15. Enter that coupon code to save on any of our memberships and gain access to our tools and strategies and courses and insights, all the things we have to offer here. What are you waiting for? Head over to followthemoney.com. Take the first step towards mastering the markets with our new 30-minute breakout blueprint course coming up. It starts this Tuesday, October the 15th. And trust me, this is one opportunity you don't want to miss.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back to one of the longest running personal finance podcasts on the web. You can find us at followthemoney.com. We have tons of free resources for you there. We have a YouTube page, or YouTube channel, I should say, with lots of videos for you. We have, of course, a Twitter page where you can find us and follow us there on social media. But anyway, we've covered a lot in this first segment. We covered the great rally that's going on in gold and silver. But as important as those metals are, we can't ignore the broader markets. Before I get into everything in the broader markets, I want to just briefly tell you a couple of key levels we're watching on gold and silver. Right now, if you look at the 200-day moving average on gold, it's sitting at around 2350. That really happens to be a major area of support for gold, but all the way up to, say, around the $2,500 level. That's where we would be watching in the near term for overall, trying to find where's the key support on gold. Additionally, if you're looking at silver, we've seen silver really break out strongly. There is some major support on silver around the 31 area, around 3150 or so. This is a key area of support for silver. And then the 200-day moving average is way down at around $28. So, you can see that silver has really been taking off as of late. So anyway, there's just a little bit of update there on what we're looking at when it comes to gold and silver in terms of the support levels. Now, let's move on because, after all, everything is connected, and the performance of stocks and bonds and the US dollar and cryptocurrencies, they all have an impact upon your portfolio. So let's take a few minutes to zoom out and let's get a snapshot of what's going on in the broader financial landscape here in 2024. And we always like to start with the S&P 500, the bellwether for the U.S. stock market. And right now we're seeing some pretty interesting dynamics play out. The market has been surging to new highs in recent weeks. We've seen a very strong rally in the S&P 500, where we have enjoyed, 6 straight weeks of gains. And this week, if we also notch another gain, it'll be 7 straight weeks of gains for the S&P 500. Now, on one hand, you have the Fed's rate cutting cycle, which is generally good news for stocks. Historically, lower rates tend to support higher stock prices, especially in sectors like utilities, which has really done well this year. Also real estate, to a lesser extent this year. But on the other hand, there's concerns about, corporate earnings and slowing economic growth, and that kind of weighs on the market right now. So for Q3 2024, we just recently entered the earnings season, and so far 14% of S&P 500 companies have actually reported results. Of those, 79% of those S&P 500 companies have reported a positive EPS surprise. That is, they basically reported positive earnings to the upside. And 64% of S&P 500 companies have reported a positive revenue surprise. That is, they had better sales than were expected. Now, for Q3 2024, if you look at the blended year-over-year earnings growth rate for the S&P, it's about 3.4%. That's the actual growth rate for the quarter. And if that ends up being the actual growth rate, by the time we're all done, that will mark the 5th straight quarter of year-over-year earnings growth for the index. But it's also the lowest growth rate we've seen in about 5 quarters, largely because the index is still navigating inflation, higher interest rates, which are slowly coming down, and then global uncertainties, as we mentioned, the election and the geopolitical tensions in the Middle East and all of this. Now, here's what's also interesting. If you look at tech stocks, they are once again at the forefront. Companies like NVIDIA, which we own for the long term, Alphabet, which we own for the long term, in full disclosure, they're leading the charge in terms of earnings growth, but investors are also, struggling, as we mentioned, with the geopolitical uncertainty. Anytime there's instability, whether it's political or economic, it injects volatility into the markets. And so, the S&P 500 is holding steady up near record levels right now, but investors should keep an eye on upcoming earnings reports, also on the geopolitical situation. These can easily push the market in one direction or the other. Now, the next market I want to look at is the Nasdaq 100. And the Nasdaq 100 is a market that we like to invest in. It's heavily weighted in tech stocks. And after a great strong start to the year, tech had become a little bit wobbly as of late, where the Nasdaq 100, which is very tech heavy, was not really hitting new highs. In fact, it's still trading just below a record high, whereas the S&P had kind of blasted past its former all-time high and hit new highs, kind of leading the Nasdaq this year. So we've seen a few key players like Apple, Amazon, Tesla, when they've reported earnings that haven't really been disastrous, but they haven't really, wowed the market. And these companies are facing challenges from higher costs, supply chain issues, interest rate pressures, and all those things, et cetera. So tech stocks are highly sensitive to interest rates because they use that as a function of their future growth rate. And so as rates drop, we may see renewed interest in tech, but for now, the sector is in a little bit of a holding pattern. We've certainly seen the Nasdaq do well this year, but it's not doing as well as the S&P 500. It is trading just below a new all-time high, though. We've certainly recovered off of those August lows on QQQ, which is the Invesco Nasdaq 100 ETF that we like to track. One thing to watch with the Nasdaq is the broader trend in AI and technological innovation. Companies that are leveraging artificial intelligence and automation are still leading the charge in 2024. I expect we'll see more growth in that space for sure as we go forward. But you've got to really be discerning here. I mean, some tech names are overextended. Some of them may be, in for a correction. And I think a lot of this will be determined in the wake of the 2024 election. A lot of people are trying to figure out where to be positioned based upon who's going to win. And you'll see in the wake of the election, in the wake of the results, you'll see a lot of money shifting around. And you may recall that from the 2016 election, where the markets, had a pretty big reaction to the outcome. And the same thing in 2020 to a lesser extent. And so I think as we're just 2 weeks away or less now from the 2024 election, we just need to be prepared, for potentially a shift in many different sectors, and especially in a few different key industries. We could certainly think, for example, that if we have a Harris victory in the 2024 election, well, then, companies that are dependent upon clean energy companies, EVs, some of these different industries, we would expect these would, really rebound and do well in that kind of environment. Solar energy, for example. Whereas if you have a Trump victory, well, then, big oil is very likely to rebound and do well. And there's other sectors and industries as well. You can, dive deeper into that rabbit hole and kind of figure out which ones of these industries and sectors will do well based upon who wins. Well, anyway, Wall Street's, playing that game right now. And they're trying to figure out where to be. And they're also trying to figure out, what other people think is going to happen. So here's the thing. When we finally get the election outcome, which again is less than 2 weeks away, hopefully we're going to get a clean outcome and we're not going to have to wait for, days to get the election results. But once we get them, we would expect that you're going to see a pretty big shift in the overall market. We may really begin to see a nice rally higher in many different areas. Maybe we'll see a leg lower in other areas. It'll be challenging ahead of that, trying to figure out what's going to happen. So we're just going to continue to watch, be ready, be nimble, and ready to take advantage of whatever's happening. Now let's shift gears to the U.S. dollar, because we've been seeing some interesting price action in the dollar. We've seen the greenback rally over the last several sessions after coming down to a key area on the U.S. dollar index of about 100. We've seen it since over the last few weeks. We've seen it rally all the way back up to 104 or so. And we've also seen a similar big rally in the 10-year yield. I just put out a video, by the way, which is available on YouTube called, What's Up with the 10-year yield, where we talked about, why is the 10-year yield rallying? Why is the dollar going up right after the Fed just said that they were going to cut rates, right? And there's several reasons for that. One of them primarily being that you have a sell the news event, which, people have been buying bonds up into the Fed announcement. And then when the Fed finally announces rate cuts, well, then they sell the news kind of thing. But then you've also got what I was telling you earlier. We have the ECB slashing rates. We have China also shocking the market over the last couple of months with promises of big debt-based growth, strategies. And with that has led to the decline in the euro and the Chinese yuan. And when those go down, they go down in relation to what? Well, they go down in relation to other currencies, particularly the U.S. dollar. So as the yuan goes down in expectation of more debt to be created, well, that's pushing up the dollar. Also, as we get closer to the election, the dollar has also been strengthening because, again, it's that uncertainty that oftentimes drives people to the 10-year note or to the U.S. dollar, as a sort of a safe haven until they kind of wait out what's going to happen. So, but overall, we see the dollar going back down, especially when you consider the fact that we are going to be doing a lot of debt spending no matter who is president. There's going to be a lot more debt coming in, and it's going to, overall serve to weaken the U.S. dollar, especially as the Fed tries to cut rates. Now, we're going to see how all that plays out in 2025. The Fed has a plan, to overall cut rates, have them down by 3.4% on the Fed funds rate by the end of next year. Whether that happens or not, we'll see. We could be lower based upon whatever's happening in the economy. We could be higher, but at least that's the expectation now, and the market's just kind of moving along those lines. So, but again, lower interest rates make the dollar less attractive to investors looking for yield. And so as the Fed begins to continue cutting those rates, we should continue to see the dollar become less attractive. So we watch the U.S. dollar index very closely, and we let our members know what we're seeing on a regular basis. And so if that's something that you would like to follow, you really want to be a member here at Follow the Money. We've helped a lot of people over the years steer clear of some obvious danger zones, but also we've helped them stay, kind of keep their finger on the pulse of what the dollar is doing and what the 10-year yield is doing. And that helps you as an investor, even if you're just investing or even trading, just knowing that information, having it ready at your fingertips or having somebody who can, give you the information, that's very helpful. As I mentioned, we talked about that 10-year yield. That's a key indicator many investors watch because it affects everything from mortgage rates to stock valuations. And rising yields have been a headwind for stocks, especially in 2022, and then elevated rates in 2023 kind of weighed on stocks, particularly in the end of at the beginning of the year. But those yields can also hit the growth sector, and many growth stocks have suffered because of that. But they're beginning to rebound now with expectations of lower rates. And so we may see some relief in long-term bond yields over the next year or two as lower yields tend to support stock prices, as we mentioned, especially in the real estate sector and the tech sector, which are very sensitive to borrowing costs. Now, let's talk, before we bring this to a conclusion, let's also talk briefly about cryptocurrencies. And I want to especially talk about Bitcoin and Ethereum. So the crypto markets obviously have been volatile. One of the things that's been interesting has to see that Bitcoin has just really been holding steady in a sideways grind. We have been watching Bitcoin now for many years. Those of you who've been listening to the Follow the Money podcast, if you've been listening to it from the very beginning when we launched back in 2010, we were talking about Bitcoin back in 2012 or so, and then 2013 and 2014 and 2015. And we were just telling you about Bitcoin very early on, to the point where we were telling our members, I remember many times just saying that, hey, everybody should just consider going out and buying one Bitcoin. At the time, it was less than $1,000. And today, of course, it would cost you an arm and a leg to buy one Bitcoin. So many of our listeners have benefited from that. Same thing with Ethereum. We were talking about Ethereum when it was $12. These are markets we've been watching for a long time. We have strong opinions on those markets as we've seen them rise, and we've been commenting on them for, well over a decade. And so as I look at a chart of Bitcoin right now, I see that Bitcoin is struggling above a flat 200-day moving average. It's been sideways grinding since it touched an all-time high of around 73,750 back in March of this year. And quite frankly, it's difficult to go back and find on the chart a more lengthy sideways consolidation than we've seen here with Bitcoin. And there's many reasons for it that we could lay out. I think the election also, in the wake of the election, I think we're going to see a very sharp move one way or the other. You usually, when you see these sideways grinds that go on and on and on like this, they usually lead to very outsized moves when they finally break out or break down. But Bitcoin is trading, just a few $1,000s below its all-time high, and we think that's going to be hit, very, very soon. I definitely think it'll be hit, sometime in November. If we don't see it happen in October, we'll see that new high established. That's my expectation anyway. And also, when we look at at Ethereum, we've seen Ethereum also kind of come back down. It was trading up around 2750 or so earlier this month, which was the highest it had been, for a few months anyway. It's come back down a little bit. It's trading at about 2,500. It's still trading above the key 2,400 support area that we've been watching now for some time. I am of the opinion that Ethereum is also going to do very well as we move into 2025 and in the post-election era. I think we're going to see these markets really accelerate. I also like the fact that Ethereum right now is trading just above its 200 weekly moving average, which over time has been one of the better areas to catch that asset. It doesn't happen all the time. Sometimes, it'll hang around that area. But if you go back and look at a chart, that's often a very good time to be, adding that particular asset. We are long both Bitcoin and Ethereum, and we expect that crypto investors will continue to pile in, especially as we see the cycle play out in Bitcoin, the 4-year cycle, which typically resolves, based on this cycle, it should resolve, say, about a year from now. We really have about one more year left of the bull market in crypto, and I think we're going to see a very spectacular 2025. That's based upon my own, understanding of the market, the understanding of the cycles, the technicals. That's my expectation. And when we get to that peak, by the way, I plan on taking some gains, not selling my entire position, but I plan on taking some cream off the top, just like we were talking about with gold, where you have it really historically overbought. Well, Bitcoin and Ethereum are not at those levels right now, but when they get there, I plan on taking some cream off of the top of those assets as well to be able to lock in some of those gains. So, by the way, if you're in the crypto space, remember, it's obviously highly speculative. It's important to manage your risk if you're involved. We always recommend using stop losses if you're trading. And if you're investing for the long term in crypto, we encourage you to keep a small percentage of your overall portfolio there, not to let it get out of hand. For us, we allocate 5% of our total investable assets to crypto on an ongoing basis. That's worked out great for us. We like that allocation. Some people like more, some people like less. But you need to keep it manageable is what we're saying. So to wrap this segment up, gold and silver making big headlines, but the broader markets are also playing a critical role in as we move into the final months of 2024. Whether it's the S&P or the Nasdaq 100 or Bitcoin, it's important to stay informed. Be ready to adjust your strategy as the markets evolve. So let's take a quick break, and we'll come back with my concluding thoughts. Folks, it's been another packed episode today. Let's take a moment to recap what we've covered in today's episode. We started off by talking about the really nice rise in gold and silver this year in 2024. Both metals are making big headlines, gold hitting record highs, silver surging to levels we haven't seen in over a decade. We discussed why these metals are performing so well right now. We talked about inflation. We talked about the U.S. dollar. We talked about central banks. We talked about also the monetary easing and the fiscal easing that we're seeing, which could lead to growing industrial demand, particularly for silver. So if you're a precious metals investor, you know that these are very interesting times. We didn't stop there. We took a look at the broader markets. We talked about how gold and silver don't operate in a vacuum, whether it's the S&P or the Nasdaq or the dollar or even Bitcoin. All these markets are interconnected. Well, all right, friends, that brings us to the end of today's broadcast. And as always, I like to leave you with a final word. This time, it comes from J.P. Morgan, who once said, "Gold is money and everything else is credit." Now, think about that for a minute. In uncertain times, gold has always been viewed as real money. Paper assets, investments, stocks, they all rely upon some system of trust. But gold, it's self-evident in its value. And that's something that investors always turn to when everything else becomes unstable. The challenge, of course, is staying ahead of these trends, knowing when to hold and when to fold, when to pivot. And that's what we aim to help you do here at followthemoney.com. And that's just something to think about. Well, friends, thanks again for tuning in. If you're interested in learning more about how to navigate today's markets, don't forget to check out our ongoing research and trading ideas and membership options over at followthemoney.com. And also don't forget about our new 30-minute breakout blueprint day trading course. We've been unveiling that course through our weekly webcast every single Tuesday morning. If day trading is something you're serious about, you'll definitely want to take part. You can use the coupon code JUMPIN15 for 15% off any membership. Just simply go to followthemoney.com and get your information right there. Pick out the plan that's right for you. We'd love to see you on the other side. Remember, when you want the truth, friends, just follow the money. Have a safe and prosperous week, and I'll look forward to seeing you right back here next time. Until then, God bless.
Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making